This BizNews production is brought to you by Brenthurst Wealth, a multi-award-winning, truly independent boutique wealth manager. Invest better with Brenthurst.
Good morning, everybody, and thank you, Alec. And sorry for taking a little longer to walk up. I wanted to get to the drum section of that money for nothing, because my very kind wife, who's joined me at BizNews for the first time for my 40th birthday, gave me a set of drums for my 40th birthday, and I thought I was getting a gas braai. So that was quite a change. Anyway, they did come with headphones. Right, so always challenging to speak after Sai and Pete. Fantastic investors, so considered. But anyway, we'll give it a go. What I'm going to talk about today is how to stay rich and to grow your wealth in very uncertain times. And when I looked up on Perplexity, an individual is economically rich or wealthy when their net worth is large relative to others, okay? So if you look at the stats, if you're in the top 10% of the wealthy in South Africa, if you earn about $1 million a year, or if you have more than 10 million in assets, and the top 1% if you earn 2 million or more a year and 25 million of assets. Okay, so that is the kind of benchmark, and I think many of us here are very fortunate to be in this category. But Jeff Bezos, this is a story that came from the CEO of Airbnb. Jeff Bezos once asked Warren Buffett, he said, you make it sound so simple. Why doesn't everybody just copy what you do? And Warren Buffett replied, because no one wants to get rich slowly. Okay, so some wise advice. Now, Warren Buffett, for many of you, I'm sure you all know, his partner was Charlie Munger. And Charlie Munger had a fantastic clue when he was challenged with a problem. He would often invert the problem. I know Alec will know this. So let's invert the problem and say, okay, well, how do we get rich slowly? Well, let's invert it. Let's find out, how do we go bankrupt very fast? Okay, and then we do the opposite. So if you have a look at what are the 4 ways where people go bankrupt really fast, they spend more than they earn, no surprises there. That means they have no savings cushion when external shocks such as you lose your job or you get divorced or some tragedy or you've got an illness with medical bills. They use high-cost debt. Okay, that's one of the reasons why I'm strongly personally opposed to microlending, but they ignore risk and diversification. And that's where I really want to focus. So now we know what we need to do. We need to save. We mustn't use high-cost debt. We must create, that'll give us the opportunity to create a nest egg, and we must manage risk and diversify. Now, one of my favorite writers is a guy called Howard Marks. And Howard Marks is a person who Warren Buffett speaks about as when there's an article or a newsletter from Howard Marks in his inbox, it's the first thing he reads. Howard Marks says the essence of investment management, and just by the way, he's a billionaire, okay? The essence of investment management is the management of risk, not the management of returns. And he says, if we avoid the losers, the winners take care of themselves. So that's what we've got to do. How do we avoid the losers? We get the odds on our side. And so that's what we at Ranmore do. We're always trying to get the odds on our side. If we buy businesses that generate cash flow, skews the odds in your favor. If you've got strong balance sheets, skews the odds a little bit more in your favor. If you've got honest management, you don't pay themselves crazy numbers and are working for shareholders, skews the odds a little bit more. And if you don't overpay for assets, it skews the odds even further. And all those little iterations means that you then get the odds on your side. The problem is, we're still going to get it wrong. And even the best fund managers in the business are going to get it wrong 30%, 40% of the time. Okay, so how do we guard against that? Well, Nobel laureate Harry Markowitz says, diversification is the only free lunch. And the question is, well, how diversified? And what do we need to diversify into? So let's look at some of the best fund managers in history. And these are fund managers who've been successful for decades. Okay, not just 10 years when interest rates were low or a single cycle. And the first is John Templeton, who he managed a fund from 1954 to 1992, 38 years, where he compounded at 14.5%. That means he took $10,000 and turned it into $2 million, 200 times, okay? That is what that did through nearly 40 years when interest rates were high, low, recessions, no recessions, etc. He emphasized global diversification across multiple countries, currencies, sectors, and he argued against a home bias. Now, what's interesting is he had up to 100 stocks, okay? That's how diversified he was, up to 100 positions. Anthony Bolton, definitely the best investor the UK has ever known. He was phenomenal at Fidelity from 1979 to 2007, 28 years. He compounded at nearly 20% a year, turned £10,000 into 1.3 million. Phenomenal investor. He's written a fabulous book called Investing Against the Tide, highly recommended. He had between 80 and 140 positions. And he said he has lots of individual views on stocks. He wants to let probabilities work in his favor rather than making one big bet and losing in a big way. And then the third person I want to just reference is Peter Lynch. And he was, again, a Fidelity fund manager from 1979 to 1990, compounded at 29% per annum. That was a particular period, but he averaged 200 stock positions. And in fact, in 1989, before he stopped, he had 1,400 positions. But he focused on business risk more than price volatility, emphasizing a bottom up. So what's the conclusion? You don't need highly concentrated portfolios to do well. In fact, in the words of Joe Wiggins, who's a behavioral finance expert, he said, running a very concentrated investment strategy places a huge burden on being right, and it leaves you vulnerable to uncertain circumstances, okay? And there's a couple of great examples where some of you might know these names, but Bill Huang, who ran Archegos Capital, blew up. Highly concentrated, leveraged, got it wrong, boom. Bill Miller, who ran the Legg Mason Value Trust, he beat the S&P 500 for 15 straight years, taking concentrated bets, took a concentrated bet in 2007 on home builders, finance, and basically, if his fund fell 54%, gave up most of his outperformance over the previous 15 years, okay? And another guy, Bruce Berkowitz, Alec, you might remember from Fairhome Capital, he was Morningstar's fund manager of the decade in 2010, took concentrated bets, okay? 3 positions were more than 50% of his fund. AIG was his biggest bet, basically destroyed his performance historically. And if you look at Warren Buffett, how did he manage to preserve his wealth? If you think about it, started off Berkshire Hathaway, little textile mill. As he grew, positions increased and increased. He got more and more positions such that they're hundreds. So as for an entrepreneur, you might start in one particular, area. Let's think in a recent example. Let's say you were a Dubai property developer. You went there in 2002, you saw this opportunity, the whole world's moving to Dubai. I know what I'm going to do, I'm going to get into property. You bought a property, did well, you bought another one, did well, bought another one. You kept putting the money back on black. What happens? A couple of drones. How much is that property portfolio worth today? So what you want to do is as you get wealthy, you diversify more and more, and that'll ensure that you stay wealthy. But then you might say, well, hang on, Sean, in 1996, Warren Buffett said diversification is protection against ignorance. And I'll then say, well, go and have a look at the annual report. In 1996, he had 31 businesses and insurance businesses. Okay, so what we think is concentrated, of 4 positions, 5 positions in our personal portfolio. Warren Buffett, when he was talking about being concentrated, he had 31 positions and diversified insurance companies. So a key thing is don't be too confident, I think, about your circle of competence. Okay? When you want to invest, you might think, I'm an accountant, I understand Xero, there's this business Xero, it's listed over there, it's a fantastic product, great. You're down 46% in the last year. Or you might say, I'm a designer. Adobe wanted to buy Figma. Figma's a fantastic design program. I'm going to go and buy Figma when it lists, down 76%. Or you're a doctor and you prescribe Novo Nordisk's Wegovy, and you've seen your patients lose weight, and you think this is the answer. These guys lose weight. This is a fantastic product. You're down 59%. Okay? You're operating in your circle of competence, but what you don't know is what's priced into the share. And there is no rule which says that the more you understand a company, the more money you make. So overconfidence bias is very dangerous. And I mentioned that buy property, there's nobody who understands Bitcoin arguably more than Michael Saylor. MicroStrategy is down 70%. Okay? So be careful about overconfidence. You might then say, but hang on, Sean, I watched a video recently with Stanley Druckenmiller, and he's worth $10 billion, and he says, why don't you put all your eggs in one basket and then watch the basket? You might have heard that, okay? And my answer to that is what he should have said is put all your eggs in one basket and manage the basket, because that's what he does do. He doesn't watch Bitcoin go down 70%, just watch the basket, okay? They manage the basket. And there are a few very successful managers who manage the basket. Stanley Druckenmiller worth $10 billion, Bruce Kovner worth $8 billion, Paul Tudor Jones worth $8 billion. They manage the basket. But here's the thing, they don't lose more than 1% to 2% of their capital on a single idea. So you might want to say, I'm going to, and that is the key thing. So if you're taking 10% positions, that thing falls 10%, they're gone. They've hit stop loss, they're out of there, okay? And that is very challenging emotionally. You heard Pete reference Jesse Livermore taking his own life because it weighs on you. You know, imagine if you'd taken 10% position, you watched this company, you'd heard about this company, NVIDIA. It's December 22, just before AI kicks off. You say, I think this NVIDIA is going to be a winner. And you put 10% of your portfolio in. NVIDIA was $18 at the time. Okay? But you're applying this rule. Falls 10%, I'm out. Guess what? Within the month, NVIDIA fell 10%, you're out. You cut it, it ends the year at $14. Just for reference, it's currently $180. Okay? So now how are you coping with that emotionally? But then you go, well, I'm not giving up on this AI idea. I'm convinced it's going to be good. And robotics is quite a theme as well. I'm going to take whatever's left, that 10% position, I'm going to go put 10% in Paladine AI. What they do is large language models for robotics. I mean, what a story. Okay? You buy it at $3.36, it's currently 35 cents. Okay, so you lost 90%. So meanwhile, if you just put 1% in NVIDIA, the thing's 10%, you've lost basically 10%. So these are the kind of emotional challenges that can come from having concentrated portfolios and then managing them aggressively. Much better to take larger number of positions, we would argue. So you want to be diversified, key thing. But you want to know that your assets are safe and liquid. It's no good being diversified in lots of other products in private credit that's illiquid, that you can't get hold of it. And so we've had a couple of financial disasters where people have put them into trusts and all sorts of structures here. And in the UK, I had a client who unfortunately invested in the Novus Black Fund, which is not actually a regulated fund at all. So to guard against that, I would say you need to know three things. First, you need to know that the investment vehicle that you put your money in is regulated. And ask AI. You know, if you go on there and you say, who regulates Ranmore Global Equity Fund, they'll tell you the Central Bank of Ireland. And then you ask another question of AI, you say, well, is the Central Bank of Ireland highly respected as a regulator? And they will tell you yes. So know that where the money is regulated. Understand the how good that regulator is by be a globally respected regulator. So those are, I think, some good ways to protect your capital. Be diversified in regulated products which are liquid, that you can get your money when you need it. Okay, that'll give you a cushion. But you don't want to be rich and miserable. Those are the words of a Kenny Chesney song. And multiple studies around the world have shown that those who are generous, who donate to charities, are happier. And go and have a look up at OpenAI. And I mentioned Paul Tudor Jones. He started a charity called the Robin Hood Foundation, which is fantastic. And so what I'd committed, Alec, a few years ago at the Biz News in the Drakensberg is that when our assets exceeded $200 million, we would start a charity. Our businesses ran more. We started a charity called Help More. And today we have grown beyond that. And I'm delighted to say that our CEO, Jamie, is here with us, and Kim Finketz, who's been instrumental because we had an interesting walk as to how do we get involved in giving to these charities, and Kim came up with some fantastic names. But small businesses create jobs and economic growth, and small charities create jobs and economic growth because they are small businesses. And they don't pay money to shareholders, so they're reinvested. And so the key question is, okay, well, how do we invest in charities? And how do we know that our money is going to be safe? And we started this thing called the Help More Trust Index, and we're launching it today. And so the Help More Trust Index is a list of charities that people can have confidence that the money is getting to the end beneficiaries. And so if you know of any charities that you want to propose for the Help More Trust Index, that would be fabulous. We'd love to know about them. And what we're trying to do is, for us South Africans who are overseas, and there might be some more people moving back from Dubai, how do we give back to South Africa? We want to be able to give back to those charities. And entrepreneurs can start businesses, but even if you're retired, you're not going to start a business, but you can create jobs by giving to charities, and that'll make you happier, and you'll have more money to give because you'll be diversified and liquid. All right. Alex asked me to talk about money. So I remember one of his excellent morning briefs that Alec had gone up to Caledon to renew his passport. And there was this lady, her name is Sandra Cronje, Pastor Sandra Cronje, and she's affectionately known as Mummy. And she had a feeding scheme close to the Department of Home Affairs up here in Caledon. And Alec was intrigued by the long queue and went to go and say, what's this long queue? Is this for passport control? Because there's another long queue over there. And I said, no, this is a feeding scheme. And so he wrote about it in one of his mornings. And we've got a place near the Leersdorp. And so I said, this is very interesting, Alec. Can we get the details of this lady? We'd like to help her. And so we support Mummy, and she feeds 200 people in Caledon. And the amazing thing about when you get involved, rather than just writing out checks, you get to meet these people. So about a year ago, I went to go and get a passport renewal with my daughter. And we went to go and look for Mummy, which we've been sending money to, for many months. And what an amazing person. And this is, it really does inject joy into your life. When you get to meet Sandra Cronje, every month she sends me a lovely WhatsApp thank you message and all the rest. So anyway, that's the story about Mummy. But yeah, lovely person. And there again, you're supporting them, you're supporting the homeless people. Things can go, and people can become homeless from just not applying these rules. They lose their job. The spouse leaves them. Their siblings are no longer around, and they're on the streets. And so anyway, it's a lovely story, Alec, and thank you for introducing us to Mummy.
This BizNews production is brought to you by Brenthurst Wealth, a multi-award-winning, truly independent boutique wealth manager. Invest better with Brenthurst.